Welcome back to the deep dive. We're here, as always, to cut through the noise.
That's right.
Our mission, taking all that dense financial info, those complex case studies, sometimes confusing advice,
Mm-hmm.
and turning it into real wisdom, stuff you can actually use in your life, starting now.
And today we're navigating, well, maybe the most important part of building wealth, your mind.
The psychology of it all.
Exactly. We're calling this our mindset over money deep dive. Less about the market charts, more about the mental roadblocks.
And the practical mistakes that trip people up, even with good strategies.
Precisely.
Okay, so we've got quite a journey lined up. We're digging into the painfully slow lesson from an early options trading mistake. Remember the tiger stock story?
Oh, yes. A classic. We'll pull out the key lessons from that, then we'll zoom out a bit.
To the big picture,
Yeah, the timeless stuff. The psychological blueprint for wealth from Think and Grow Rich.
a foundational text.
Absolutely. And we'll wrap things up with a truly memorable example of how not to plan your legacy.
You need the $12 million dog.
The $12 million dog inheritance drama. It's quite the story. But it perfectly shows why planning needs to consider human emotions, not just spreadsheets.
Okay, let's definitely unpack that. But first, that cautionary tale. Risk management failure disguised as options trading. The tiger stock saga.
Right. This one's a masterclass, really, in how early mistakes often come from just ignorance, a fundamental lack of research.
So the trader was selling puts on Tiger, trying to collect that premium income.
Exactly. Selling puts.
Maybe just quickly explain for anyone newer to this, what does selling a put actually mean in practice? Because that's where the trouble started, right?
Right. So when you sell a put, you get paid a little bit of cash, the premium, right away.
Nice. Seems like easy money.
It can seem that way, but
Yeah.
you're also taking on an obligation. You're promising to buy the stock at a certain price, the strike price, if it drops below that level by expiration.
So a short-term income play can suddenly become a long-term stock ownership commitment.
Yeah. Bingo. And that is exactly what happened here. The trader got assigned 300 shares of Tiger at $17.50 per share. This was a few years back.
And the kicker, Tiger doesn't pay dividends.
Correct. So if you're forced to buy and hold it, you're not getting paid while you wait for the price to recover. You're just waiting and hoping.
Ouch. But initially, things looked okay, even good.
Yeah, and that's what made it dangerous. The stock actually went up. It hit $27 a share.
Nice game.
Huge. So the trader smartly sold 100 of those shares, locked in a really good quick profit. That was the right move.
Okay, but then the remaining 200 shares.
Then the greed factor kicked in.
The classic trap.
Yep. The target for the rest was $30 a share, just a little bit more.
It's just a little bit more.
But instead of hitting $30, the stock just cratered. It plummeted. I mean, down to $3.39 at one point.
Wow, from $27 target, $30 down to $3.39. That's brutal.
Brutal. And holding through that emotionally, that lasted for years.
So how did it finally end? Did they get out?
They did, eventually. Managed to sell everything. And believe it or not, ended up with an overall profit of $3,402.
Okay, so a profit is a profit, but spread over 4 years.
Exactly. That's the real lesson here. It's not just the final number. You tied up a decent chunk of cash, went through 4 years of, frankly, stress,
Yeah.
to make about $850 a year on that money.
That's not a great return on your emotional energy.
Not at all. That stock wasn't an investment by the end. It was like a homework assignment you couldn't get rid of.
So the real takeaway isn't just about options mechanics. It's opportunity cost, emotional burden. Was 4 years of that stress worth $850 a year?
Almost certainly not. And this leads right into the core lessons, the universal stuff you have to take from this.
Let's nail those down. Rule number 1.
Know your stocks. Simple as that. Do the research before you trade options on it. If you don't get the company, you might end up owning it for a long, long time.
Right. It stops being a trade and becomes an unplanned, maybe unwanted, long-term holding. Especially painful if there are no dividends, like with Tiger.
Exactly. Second big lesson. Don't be greedy. Self-control.
Easier said than done sometimes.
Oh, absolutely. But when you hit your reasonable profit target, take the win. Pocket the money. Waiting for that extra little bit, it can vanish so quickly, there's no crystal ball. Secure the gains.
Secure progress over chasing every last potential dollar. Makes sense. And the third rule.
Basic risk management. Only risk money you can afford to have tied up. Possibly for a long time, like 4 years long in this case.
Yeah.
If you might need that cash for bills, emergencies, or even just, better opportunities that come along, it shouldn't be locked up in something volatile like that.
Okay, so the Tiger case, really highlights self-control, research, risk management. But what if the issue isn't the stock itself, but us, the person making the decisions?
Ah, now you're getting to the heart of it.
That's where the psychology comes in, right?
Thought.
This whole idea that financial freedom is more about your mindset than your actual bank balance.
That's the core thesis. Mindset over money. Our beliefs, our fears about money, they act like invisible walls. Money itself doesn't create habits. It just, well, it amplifies what's already there.
How so?
If your underlying mindset is one of abundance, you see money as a tool for growth. If it's scarcity, then even having money just creates anxiety. Worry about losing it.
Okay, and we need to spot these mental barriers. I mean, most of us kind of know them in theory, but let's connect them back to that tiger trade maybe.
Good idea. So first, scarcity thinking. We saw that, right? The trader focusing on the last $3 they didn't get.
Right, the $27 to $30 part.
Instead of celebrating the massive gain they already had, scarcity fixates on what's missing, drives fear.
Then there's low self-worth, people feeling like they don't really deserve wealth.
Yeah, and that can lead to self-sabotage, making impulsive, risky moves because deep down, maybe they expect to fail anyway. It's subconscious sometimes.
We also see risk aversion, being so scared of losing anything that you avoid potentially great growth opportunities altogether.
And the big one, immediate gratification.
Wanting it now. The quick buy, the splurge.
Exactly. Prioritizing that short-term pleasure over the slower, less exciting, but ultimately powerful compounding gains that build real wealth long-term.
So it's not just about knowing these barriers exist. It's about actively cultivating a different mindset, a wealth-building identity.
Yes. Shifting focus to abundance, not scarcity. Adopting a long-term view. Seeing calculated risk not as terrifying, but as a necessary path to growth. Replacing that nagging doubt with disciplined faith in your plan.
Which transitions us perfectly to Think and Grow Rich, nearly a century old, but still relevant because it focuses on conquering your mind first.
Absolutely. It confirms this idea that the best financial advice is often timeless. It's about mind control over market timing.
The book's big claim is pretty bold, though. Every great fortune begins as a thought. I mean, millions of people think about being rich. Does just thinking about it really work? Doesn't seem enough.
Right, and that's a fair challenge.
Yeah.
It's not just passive daydreaming. The core idea is you need an intense, a burning desire for wealth. And crucially, you have to commit that desire to a definite, written plan.
The plan.
Without that burning desire and the concrete plan, it's just a wish. It evaporates. The book argues success really comes down to relentless persistence, sticking to the plan.
And why is persistence so critical, even today?
Because the biggest threat to your financial success usually isn't a market crash, it's you giving up. Most people quit. Procrastination, indecision. They kill more dreams than bear markets ever do.
Oh.
You have to conquer those internal obstacles first.
The book gives a very specific action step for this, doesn't it? To make it tangible.
It does. It's about forcing clarity and commitment.
Yeah.
You literally write down a specific number, your wealth goal, not just get rich, but an actual dollar amount.
Yeah.
You set a firm date to achieve it. Then, and this is key, you list exactly what you'll give in return. What value will you provide?
So it's not just about receiving.
No, it's a transaction, an exchange of value. And then you read this written statement aloud, twice a day, morning and night. It's like combining visualization with a personal contract.
Interesting. And building on that is the mastermind idea, which isn't just hang out with rich people, right?
No, it's more sophisticated. It's about forming a synergistic alliance, finding peers, mentors, maybe partners who share your definite purpose and plan.
So it's about mutual support and accountability.
Exactly. It creates an environment that fuels persistence. It combats that lone wolf tendency where you might quit because you feel isolated. The simple takeaway, surround yourself with people focused on growth and making things happen, not just complaining about being broke.
Makes sense. Okay, so if you've got the mindset right, you're persistent. What about applying that to today's world? The sources also touch on current strategies, right?
Yeah, definitely. We need to connect the mindset to modern opportunities for income and growth.
Okay, so let's talk earning potential. There's this comparison between, say, YouTube and TikTok for making money in 2025. What's the key difference?
It really comes down to speed versus stability. TikTok can give you that quick viral hit. Potentially explosive income, but often short-lived, tied to trends.
Fleeting fame and fortune.
Kind of. Whereas YouTube generally rewards the long game, building a loyal audience slowly, steadily. The monetization there is historically more stable, often higher over time.
So YouTube's more like building a business. TikTok's more like hitting a trend.
That's a decent way to put it. TikTok success can feel more like a fluctuating, trend-based salary. YouTube, if done right, can be more like a sustainable long-term income stream, maybe closer to a traditional remote work gig in terms of stability eventually.
Interesting choice you have to make there. Okay, back to markets. For people who've, learned their Tigger lessons and are looking at more advanced stuff.
Right. The sources do review some successful real-life options trades, things like straddles and strangles. These aren't for beginners, obviously.
Definitely not.
But they show that sophisticated strategies can work when used properly. A straddle, for instance. You buy both a call and a put at the same strike price.
Betting on big movement, but not sure which way.
Exactly. You're betting on high volatility. Great for uncertain times, like around earnings announcements or big news events. It's a calculated risk on movement itself, a world away from selling, puts blindly, like in the Tiger case.
Gotcha. And finally, looking beyond stocks and options. Real estate. Any pointers on global markets for 2025? For that dream vacation home or rental property abroad?
Yeah, the sources highlight a few areas, places driven by, say, favorable tax changes or demographic shifts. Parts of Southeast Asia are mentioned, some specific low-tax spots in the Middle East.
What's driving growth there?
Often, it's strong rental demand combined with government incentives for foreign investment. Sometimes new regulations or major infrastructure projects act as catalysts. These markets can offer a different kind of opportunity, maybe complementing the volatility elsewhere in a portfolio.
Okay. Mindset. Classic wisdom, modern strategies.
Mm-hmm.
Which brings us to the grand finale. The ultimate planning failure.
Ah, yes.
The completely avoidable drama of the $12 million dog inheritance.
The millionaire dog trouble. It's, well, it's quite something. But it's more than just a weird story. It shines a huge spotlight on flaws in emotional estate planning.
So what actually happens legally when someone tries to leave millions directly to a pet?
Well, the intention is usually pure love, right?
Of course.
But in the eyes of the law, pets are property. You can't directly leave property to property. More importantly, leaving such a huge sum that way almost guarantees legal challenges.
From who? The family.
Usually, yes. The human heirs who feel they've been overlooked or unfairly cut out, they sue. And what happens is these massive legal battles just eat away at the estate's value.
So the money gets spent on lawyers instead of the dog's care.
Often, yeah. A significant chunk can disappear. And worse, the original wishes of the person who died. They often get completely overturned or drastically changed by the courts. The whole thing turns into a litigious mess.
So how do you make sure your wealth goes where you intend? Whether that's family, charity, or, yes, even ensuring long-term care for a beloved animal.
You absolutely need a clear, solid, professionally drafted estate plan. For pets, specifically, you'd use something like a pet trust.
A pet trust.
Yes, it's a legal structure. You appoint a human trustee to manage the funds specifically for the pet's care, outlining instructions, standards of care, what happens to leftover funds, etc. It's legally sound.
Okay, so professional planning is key.
Critical.
Yeah.
But here's the deeper wisdom. Good planning also means managing expectations. You can't just ignore the likely emotional and legal reactions of your human heirs. You need to anticipate potential challenges and structure things to mitigate them. Communication during your lifetime can help too, sometimes.
Wow, that really ties everything together, doesn't it?
Oh, yeah.
From the tiger trade mistake driven by greed and lack of planning to the millionaire dog issue caused by emotional decisions overriding sound legal planning. The mechanics might seem different, but the root cause psychology and planning failure is similar.
Absolutely spot on. The how-to information, the strategies, that stuff's everywhere. You can Google option strategies or pet trusts. But the wisdom, the right mindset, the patience, the foresight to plan properly, the discipline to conquer your own greed or fear. That's the missing link for so many people.
So what's the bottom line for you listening? It means you have the tools now. You've heard the evidence that mindset really does shape the outcome. The obligation now is on you to act. Decisively, disciplined action.
Yeah. Don't be the person stuck in a bad trade for 4 years because of hope and ego. Don't be the person whose legacy gets tangled in court because of emotional, unplanned decisions.
Take that spark you felt today. Maybe it was writing down that wealth goal or reviewing your risk rules or finally calling an estate planner and actually do something with it. Make a move.
Exactly. And as you do move forward, keep this core idea in mind. Financial independence isn't just about the number in your account.
It's about controlling your time. Your choices.
Your time, your choices, your emotions. Build that internal capital first. That's the real foundation. Just to maybe double check, what a dividend is before you start selling puts. Okay.
Yeah.